So, good morning, everybody. I'm Marty Rosendale, CEO of the Maryland Tech Council, and this is the BCTF Executive Insight Series. The Business Continuity Task Force, or BCTF, was formed during the pandemic with executive mentors from our venture mentoring service to assist company executives facing the pandemic recession. Today, we're focused on building business resilience and facing current challenges of workforce, inflation, and global economics. If you're interested in speaking with an executive advisor, go to our website at mdtechcouncil.com and you'll find a brief and pretty easy to complete application there. The Maryland Technology Council is the industry trade association that represents the technology and life science industries throughout the state of Maryland. Together with our members, we're improving the business climate in Maryland and helping our companies that save, secure, and improve lives around the globe. Before we get started today, I have just a couple of housekeeping items for you. For now, your microphones are on mute. I will be monitoring the chat and the Q&A functions during the discussion today. So please use the chat, use the Q&A. If you have questions, if you want to make comments, we can incorporate them into the conversation. This Zoomcast is being recorded and it'll be made available to others to watch or listen to in the future. My guest today is Bret Schreiber, Vice President of Life Sciences and Technology for Fulton Bank. Bret is a longtime supporter of the Maryland Tech Council and businesses, entrepreneurs, and innovators in the state of Maryland. Bret, welcome.
Good morning. Thank you for having me today.
So, Bret, I know you've got a slide deck. I'm going to pull it up right now. And, basically, if you would, let's start with your background. It'd be really fascinating to hear how you got to where you are. I know you started in economic development. You got into government services, and now you're a banker. That's a pretty interesting path. So
very much traditional path to banking. Actually, I spent 20 years in public policy, in government relations. For a decade, I was helped to head up state relations for the Johns Hopkins Institutions, which represents the health system, and Johns Hopkins University, and was their face and voice in Annapolis, advocating for dollars to support Hopkins and all the great things that they do. It was a great way to really get embedded into what's happening at Hopkins at various levels within the health system and the university and the various departments. And then particularly around that time in the early 90s, the interdisciplinary research that really just started to begin at Johns Hopkins, where he had the School of Arts and Sciences working with the School of Public Health, working with the School of Medicine working with the School of Engineering. So it was really a great opportunity. For a decade after that, I represented what was called the Maryland Independent College University Association. So that represented all the private nonprofit colleges in the state of Maryland, continuing to represent Hopkins, but Loyola, Maryland Institute College of Art. And there was 14 other independent colleges, and with that I was their face and voice not only in Annapolis but down in DC, representing your interests before the federal government. I had a small stint with Harford County representing the external affairs before I was brought into the Maryland Department of Commerce with Secretary Mike Gill, who was secretary for 4 years left, and now he's back. I did two things with the Department of Commerce. First, I was brought in to start what was called the Office of Education and Innovation, which was the very first time that the state had really provided outreach and support to colleges and universities from an economic development standpoint, and really started to take a close look at our innovation ecosystem. Before that, there was kind of an arbitrary number, 25 employees and less, and the state really was not working to do all that much. 25 employees and more they were, but as many of us on this call realize today, it's the innovators and entrepreneurs that are in the companies with 25 employees and less that are the future economic backbone of the state and region. So, and then after a couple of years of running that office, which was really to create a collision between the two tech transfer offices and the innovation ecosystem, I ran what was called the Office of Biohealth and Life Sciences for the Maryland Department of Commerce. And that was really the key point of contact for the state to building out the life science ecosystem, working with everything from the 1 to 2 person startups all the way up to the Merck's and the Pfizer's and AstraZeneca's and the GSK's and the Kites. Key point of contact, Maryland, as you all know, is very fortunate to be home of 74 federal labs, all the institutes, the NIH, FDA, NIST, DOD. We have a lot of great military installations with Aberdeen Proving Ground and Fort Detrick, and then also worked a lot with our international embassies, trying to export technologies across the world, and also try to recruit companies across the world into the state of Maryland. From there, and we'll get into Fulton Bank in a second, but Fulton Bank was relatively new to the state of Maryland around late 2019. And as they were moving into the area, realized, started with Baltimore, that Baltimore had a really heavy innovation ecosystem and life science ecosystem. And a traditional bank didn't know how to support companies in that space. And I'll get into that in a little bit. But they started to talk to us in the Maryland Department of Commerce, and one thing led to another. And they asked if I was interested in creating a new division at Fulton Bank, focused exclusively on supporting life science and early stage innovators and entrepreneurs. And it was an interesting opportunity for someone that has never spent a day in banking to run and jump to a bank and create a brand new division for a bank that's focused in on supporting such a critical part of Maryland and the biohealth capital region's economy.
Hey, Bret, I know that your next slide is about Fulton Bank, but before we go there, what created your passion? Why banking, and why are you passionate about it?
Well, I got to tell you, so when I was at the Department of Commerce, one of the most important things that we learned about companies, the two things that companies need are capital and talent. And obviously at the Tech Council, you have very robust programs that are focused at both. So for me, the capital piece, trying to deploy capital to companies, was certainly critical and important, but really was an opportunity to work exclusively with companies one-on-one. At the Maryland Department, I was doing that, but certainly had a lot of other efforts that were kind of coming in and drawing attention from just spending time one-on-one working with companies. So the opportunity to start a new division at the bank to help deploy capital and work with companies day in and day out to help them get to the next stage of their life cycle really was a fantastic opportunity that was really tough to turn down. And as you all know, we have probably the fourth most robust life science and technology ecosystem in the country. And the ability to try to continue to find ways to support that was really an exciting opportunity. And never been one to back down from a challenge, and the lack of banking experience wasn't something that at least at that time didn't deter me. So was more than happy to jump headlong into this new opportunity.
That's great. That's great. All right, so let's hang on just a minute and
go real quick to slide 3.
Let me pull the slides back up. I didn't mean to stop sharing my screen. Hang on just a second. There we go. Okay.
So I figure if it's okay with you, just give a quick, like 10, 12 minute introduction in terms of what we're doing. It might set the stage for some of the conversations at the end. That sounds good.
Yes, please.
Yeah, so Fulton Bank, just real quick for the folks on the webinar here, we're a $26 billion financial institution, a retail bank that's in 5 states, New Jersey, Pennsylvania, Maryland, Delaware, Virginia, and the District of Columbia. We started over 140 years ago, basically lending money to farmers, and have expanded to 5 states since. The Fulton name is named after Robert Fulton of the steam engine, so I guess you could say innovation and DNA is in our blood. And the efforts in Maryland, really Fulton was relatively new in the state, late 2019. We had operated under what was called the Columbia Bank, which is a subsidiary that folded into Fulton Bank in 2019. So for all intents and purposes, Fulton Bank was new to the state of Maryland in 2019. If you could go to the next slide real quick, just to show you how we got started. As I was mentioning earlier, the life sciences and technology division at Fulton Bank started when Fulton Bank was moving into the Baltimore and Philadelphia areas, and realized that there was a large innovation life science ecosystem. And for a traditional retail bank, you can imagine a conversation on how this might work. Your life science company, you go to the bank, hey, listen, I'd like to borrow $1 million. And the bank starts to ask a couple questions. Yeah, that's great. Let's see. Looks like you're in the oncology space. You need FDA approval. You're probably 10 years away from having some sort of approval. And oh, by the way, you got to go through 2 or 3 phases of clinical trials. And so technically, for all intents and purposes, you have no commercial product, no revenue, and you want to borrow $1 million. And typically the bank would say, thanks, but no thanks. Same as on the innovation side. The statistics are 86% of these companies are really in 1 to 3 years aren't going to exist anymore. So you got an early stage company coming to the bank asking for a $200,000 line of credit. The bank's going to say, listen, you got a negative $200,000 net income. You got an 86% chance that you're not going to be here next year. And so basically, the bank, from its traditional conservative nature, basically passes on the opportunity. So, and as you can see on the slide here, right now, in the private equity, venture capital, corporate M&A, IPO liquidity market, the debt, from a bank really isn't existing for companies in the early stage life sciences and company space. And if you want to go to the next slide, you can also see here, as it starts to pop in, the various industries in which this type of funding is going to. You can see it's going to, it might not be completely clear on your slides there, but it's going into social sciences, pharmaceuticals, and it's pretty much evenly distributed throughout, which is a good reflection of also Maryland's economy. If you want to go to the next slide, number 5. Again, this is a breakdown of the amount of dollars that are going into the various industries in life sciences and manufacturing. And then go to the next slide, please. And so as you can see with that, with a couple of those companies, the dollars have been equally distributed among various industries, but debt was not a common use of funding for early stage innovators and entrepreneurs. It was usually private equity, it was venture funds, it was grants and the like. And typically companies haven't used debt before because one, these are very early stage companies. Usually banks have needs for credit ratings. There's fixed payments that are due, so cash flow is usually an issue. Usually collateral is a big deal. Most banks are going to be asking for some sort of personal guarantees, and cash flow is king with these early stage. So with debt, you do have to make payments without fail. And so this is one reason why early stage companies are kind of passing on debt. You could go to the next slide. So, if you're trying to decide, a lot of these companies are deciding what's good for a company in this fairly early stage, whether debt is an issue or equity is an issue. So, if you're an early stage company, you're trying to think about if creditworthiness is an issue, you're going to use equity. If you're an independent operator, you're going to use debt. If you are concerned about diluting your shares, then you want to use debt. If you're concerned about day-to-day payments, then you want to use equity. Are you confident that the business can generate a profit? If you are, you want to use debt. Or do you mind sharing decision-making with equity partners? So these are different types of things that companies in the early stage need to think about if you're going to use equity, which is private fundraising, or debt, which is using a bank. If you want to go to the next slide. So again, how did this come up? Why Life Sciences and Technology Division at Fulton Bank? You can go to the next slide, Marty. As I mentioned before, there was a lot of really great opportunities. I talked to you about some of the challenges that a typical banker would face when they're looking at these companies. But as you might imagine, the bank also was realized of the strong innovation ecosystem. As you can see on this page, when I was at the Maryland Department of Commerce, for example, there was a company called Benavir. At the time when we were working, they had maybe 17 employees in the oncology space, and but Janssen Pharmaceuticals, so the pharmaceutical arm of Johnson & Johnson, realized that they had a unique technology that Janssen did not have in their pipeline. And so eventually there was an acquisition of $1.3 billion. And as you can see up on the screen, there's been a lot of successful exits, a lot of successful investments. In Baltimore, we like to talk about our favorite entrepreneur, Kevin Plank, 1996, selling T-shirts out of the back of the station wagon. You see where Under Armour is today. So for a lot of the risk I was talking about earlier, the bank also started to realize that there's a lot of potential upside if we were going to try to support companies in this space. There was some problems that the companies were trying to solve. Venture capital usually is coming in at a later stage. Banks aren't filling the gap. Companies typically needed great credit scores. And so there was really a hole that was existing, and it was the genesis of the Life Science Technology Division here at Fulton Bank to see if we could fill that hole. you want to go to the next slide. As I mentioned, we can kind of skip over this. The big pharmaceutical companies were looking to fill their technology pipeline. And as many of you know, a lot of internal R&D at pharmaceutical companies is really turning towards outsourcing from large pharmaceutical companies looking to acquire small life science biotech companies in the region as a source of their R&D. So it really created a great opportunity for the bank. What we were trying to think about is if we could build this division successfully and support companies, what would our unique value proposition be? Obviously it's to fill that hole we were talking about earlier. We wanted to try to deploy capital at a very early stage. We wanted to be hassle-free. We wanted to be sensitive to the price points of early stage companies. And we really wanted to provide access to a greater network to allow companies to scale up. We really, for many intents and purposes, wanted to be the default bank for startups. If you want to go to the next slide. So how do we go about doing this? This is really just a unique way in which we started. When we first started in late September 2019, we met with about 250 different companies in the area, and we asked one simple question: if you could work with an innovative, disruptive bank, what would you want that innovative, disruptive bank to do? We came up with literally close to 300 different ideas, and we to sort it, we did this little action priority matrix. As you can see, and some of the things that we decided would be pretty easy for us to do right away. Some were quite expensive, and we were going to put further down the board. But as you can see in that section 3 and 4, there's really nothing there where we're going to table for later or just say no. Basically, we decided that for a bank, which is pretty rare, we're going to operate in a mentality of everything is a conditional yes until it's a no, and we're going to try to figure it out. And so we did. If you want to go to the next slide. And we can really kind of, we'll skip through these real quick. I'm gonna, you can probably just skip through the next couple of slides here. Marty, I'll talk about it in a second. Keep going. For time's sake, I'll mention these. You can keep going. And go to one more. Right there, stop right there. So I'll tell you, we basically decided to do 5 things in early 2019. The first was, as I mentioned, and as you heard earlier, that not necessarily myself, but the concept of what Fulton Bank was doing by bringing someone like myself that didn't really have any banking experience into the bank. But because a typical conversation with a company from a traditional banker's perspective would say, all right, well, what's your we'd always look at it from a traditional financial metrics. What's your net income? What's your ability to pay back the debt? And 9 times out of 10, the conversation was, well, I've got a negative $200,000 net income. I really don't have a product yet. I don't have the ability to pay back anything on the debt. So my what's called debt service coverage, ability to pay back whatever it is you borrow, was typically negative. And most 9 times out of 10, a traditional banker was saying, well, listen, thanks, but you're very too early. There was a lot of intentionality to bringing in someone that was really not from the banking area, because when I started, and eventually we're going to have a team of folks like myself in our 5-state footprint. When we look at companies, we don't look at them from a traditional banking perspective. We'll look at a company and say, well, listen, you might be negative $500,000 net income, but last year you were negative $700,000. So you might not be revenue positive, but you're demonstrating a path to profitability. Check. Oh, I see you've got 6 patents. And a lot of companies, our portfolio has 6 patents. Or you're spinning out of Johns Hopkins or the University of Maryland College Park. Check. Oh, we see you've got a major investment from the Maryland Technology Development Corporation, TECCO, or you got a small business innovation research grant from the National Cancer Institute. And as many of you on this call today know, that you just can't go out and get an SBIR, a TECCO investment, an ABLE investment. You can't just successfully spin out of Johns Hopkins or have 6 patents without having a there. And so the ability of having someone that wasn't looking at a company through the traditional silo of a bank was very instrumental in saying, listen, they might not fit our mold quite yet, but this is a company that's going somewhere, and we need to figure out a way to work with these companies. So that was number one. The second thing that we did is we realized that we couldn't use our existing credit policy to support companies. So we created a whole new credit policy that we would lend to off of what I call alternative metrics for credit worthiness. And so some of the things I just talked about, patents, SBIRs, investments from TEDCO, equity from Johns Hopkins or Maryland. These became the credit policy that we would lend off of. If companies had those types of things, they were positive metrics for consideration. We would basically lend off of those metrics as opposed to lending off of the traditional financial metrics. And then what we do is every company that we work with, I'll have a traditional banker work with me so that we're dotting the I's and crossing the T's, and we're not providing a company without expertise in the traditional banking world. But this way now we have someone that may not understand your exact technology, but understands the pathway to success and the pathway through the ecosystem that you need to scale. And then you're partnered with a traditional banker. The other thing that we're going to do is that we will have equity capabilities too. So we've started in December of 2021 approval to start our own new venture opportunity. We're going to start in Baltimore in conjunction with the Able Foundation through the Propel Baltimore Fund. So we'll be able to do direct investments in companies. We have a partnership with another venture firm called Blue Highway Capital, which invests in companies with about $1 million in revenue or later. So with Propel Baltimore, we'll do early stage investment. Blue Highway will do later stage investment. We've got the ability to do venture debt, in which we'll take a warrant for coverage. And then we've got a network of venture funds that we've worked with over previous years that we can connect companies to. So we're a little bit like Silicon Valley Bank, only Silicon Valley Bank comes in at pretty much a series A, B, or C, and we're coming in pre-seed, ideation, and pre-revenue, which is very unique in this space. The last thing that we do is, when I was at the Maryland Department of Commerce, I oversaw a very large tax credit grant program, but the most important thing that we did is we would connect companies to various points in the ecosystem to help them scale. We were very much interested in seeing them succeed and grow and secure and plant their roots in Maryland and grow from there. And we're going to do the same thing at Fulton Bank, even if it's not a banking related effort. We've got a pretty substantial network that we brought with us from the Maryland Department of Commerce, and Fulton Bank has a pretty substantial network in contractual relations with investment banks, law firms, HR, tech development. These are all companies and entities that have a lot of experience with early stage companies. And the idea is that if you're working with Fulton Bank, we're going to connect you to the ecosystem to help you scale and grow, even if it's not a banking related product and service. Just one quick example: we had a life science or medical device company looking to move out of Baltimore because of expansion. So we connected them to the Baltimore County Office of Economic Development. And then we had connections to the Rochelle Institute for Biomedical Devices at the University of Maryland College Park, Children's National Medical Center in DC, and the National Consortium for Pediatric Devices. And these were all efforts that this company did not have. None of them benefited the bank in any way, but our hope is that eventually this company will scale and then we'll kind of reap the benefit. What did that do in a nutshell? This whole effort became solutions for investors, as I mentioned, Able Foundation, Momentum Fund at the University of Maryland. They want to see their companies succeed, and so Fulton Bank, the ability to come in to kind of fill a gap, was a solution for them. We're part of the economic development opportunities for state and local counties and jurisdictions. So we'll work with, for example, the Maryland Department of Commerce, the Baltimore Development Corporation, to help recruit companies into the various areas, because we'll be part of that financial solution. The higher education institutions, in terms of success of institutions transferring out of their technology, have been a critical source. So we get calls to help support these companies. We've been approached, for example, by the Office of Tech Transfer at NIH. There's a lot of companies that are trying to scale and utilize the tech transfer services at the federal government for pathways to regulatory approval, but those are very expensive options. And so we've been approached to help companies finance or try to get capital to help them along the path to their regulatory approvals or efforts and collaborations with the federal government. What's called our Urban Market Initiative, which is support for Baltimore City. We like to say we're a 140-year-old institution that's running into Baltimore, not away from Baltimore. We've recently established 5 financial centers, going to go to 7 within the city. We have a mortgage company. We're encouraging home ownership. So we realize that there's not a Fortune 100 company that's really going to come into the city and to say, here's a solution to all your problems. It's really going to grow. One major part for the solution for areas like Baltimore is the economic growth and vitality of the region. And it's going to be on the backs of the folks on this call today, our innovators and entrepreneurs, and scaling to something that's successful. So we figure our efforts to support that are going to be very critical. And then finally, we're a bridge to what's next. We're a bridge to companies for that next federal grant, your first contract, the ability to pay staff or research and development. And so, we've scaled the company, the portfolio to over 120 companies within just a little bit less than 2 years. And we're looking to move towards the future. And then Marty, if you just want to skip to the last slide and then we can move into Q&A, that would be great. So what's next? I mentioned we just got approval for our venture fund efforts in late December. We're going to put our toe in the water first and just invest in the Baltimore area. But our hope is, and if we're successful over the next 8 months, that equity and support will expand into the Delmarva region and the rest of the state of Maryland. But we will find ways to make equity support. For a lot of you that are doing Series A, B, and C raises, we want to be a topper to that. Basically, we want to extend the runway for your equity raises and your capital. Warrants and exit fees. These are, again, solutions for early stage companies in which traditional debt might not work, but we're going to take a lot less ownership in your companies through unique ways in which we're going to work with your companies to give you the capital you need. We are, partnering with the Association of University Research Parks, and we're also developing ways to support the growth of life science and innovation centers. A lot of us know that there's a lack of wet lab space in the biohealth capital region, and so right now we're developing some innovative solutions to help fund a lot of those efforts. We're going to look for some unique partners with TEDCO in terms of where they will seek approvals for companies, and we will follow on their approvals to provide support. I mentioned the innovation spaces, financing NIH studies, and then we do have to be collaborative with the biohealth capital region. There's a lot of companies within the Virginia and Delaware that are looking to find ways to collaborate with Maryland, and so we are providing some of those solutions as well. So with that, appreciate the opportunity to talk a little bit about us, but Marty, I'd be happy to engage in some conversations and some Q&A.
So Bret, first of all, that was amazing, and I want to let the audience know that I was having some technical challenges there with the slides, and the slide deck was actually jumping multiple slides when I was moving forward. And yeah. Bret, you didn't miss a beat. I was really impressed. That was great. But the section on debt versus equity is one of those areas where the slide deck was giving me some challenges. Let me ask you, coming back to that topic of debt versus equity, how does a company make that decision, and how do you help them? Because if they take on too much debt and can't service it, that can be really challenging.
Right. So a lot of what we've been finding out is, our sweet spot is around $250,000. Obviously, we're working on one company right now where we're looking at a $15 million facility. We'll go up to $58 million. But we've been down as low as $5,000 in terms of working capital line of credit. Financing equipment, we'll finance 100% of equipment. For example, we did a electro nano spinner, which is kind of future of smart fabric for a company here in Baltimore. But it's really not taking on too much debt. But $250,000, for example, can be a really meaningful amount of dollars. The important thing that we're doing is that this isn't high interest rate. We're not super low, we're not super high. We're about 6.25% interest only payments. So for a company to have access to $250,000 interest only payments, it's really a lot cheaper than equity in many instances. And it could be that solution like, listen, I'm waiting for that next contract, or I'm waiting for that invoice to be paid, but I need to keep the staff going. And so I will dip into a line of credit, pay the staff. When the invoice gets paid, I'll pay back the line of credit. So it's an evergreen facility. And a lot of companies are keeping debt just in case. Obviously, we just emerged, or we're kind of still technically in, but through the COVID era, and to have companies that are seeking equity dollars and have that on the balance sheet, but then to have a working capital line of credit as a tool just in case can be a very much needed tool. But it's just having that little bit of debt out there that's not really going to throw them out of whack. And the important thing about it is that what we're doing, companies never been able to qualify for this before because of what I said earlier. We're looking, traditional banks were looking at the risk, looking for personal guarantees. We're finding out ways to do things non-secure. We had one company in Baltimore, medical device accelerator. They were looking to build it out, but they said, listen, we don't get paid until we get clients in here. So what we did is we said, well, how long is it going to take you to build it out? They said about 6 months. So we did 6 months, 0 payments, and then you can start paying us back when you start to get clients in. So we were trying to figure out solutions to the cash flow needs of some of these companies too. So the bottom line is, understand debt can be harmful if you take on too much of it. But if you work with us in terms of cash flow and the amounts of debt that you're taking, it can be a pretty important tool that companies never really had access to before in this market.
So Bret, as you might imagine, given everything that you've shared with us this morning so far, one of the questions that we're being asked is, how does somebody get in touch with you?
I'm happy to throw my number out there, but 443-825-5700 or email bschreiber@fultonbank.com. And there's really no formal application process, because one thing that we realized about this space is that these companies are like fingerprints. They're so unique that we tried, for example, we tried to apply them into our credit policy. We try to create some sort of application process, but every single company is different. You could have 2 companies in the oncology space and they're completely different, 2 companies in the cyberspace. And so basically it's just a matter of, we just have a phone conversation, or we'll meet in person or virtual, however you want to do it. And then we figure out what's unique about the company, and then we craft a pathway to success based off of, your individual company's valuation and what makes them unique. And then, we'll try to find support off of that. Like I said, a traditional bank would, I think, if you think about it from this perspective, bankers only get dinged if they have a yes that goes wrong. No one ever gets dinged for a no. And so what's unique about us is everything is yes. We will try to figure out this until we can. So it's like 2 tectonic plates in terms of what we're doing. They don't really mesh. One has to go over the other and crush it. So we're really trying to find out an innovative solution to banking in this region.
Great, thank you. So we did put your phone number into the chat room, and I just want to remind everybody it's fultonbank.com if you want to learn more about the bank and get more information. Bret, what I find amazing about everything that you've shared with us is that Fulton Bank is taking on more risk than many banks are willing to take on. Right. You talked about earlier investment. You've talked about a number of things that represent Fulton Bank taking on more risk. Spend a minute telling us why. Why is Fulton Bank willing to take on that risk in this market?
Well, a couple reasons. First, and as a lot of the companies and participants on this call know, innovation is key to the success in the future. And if you're not on the front edge of that innovation, you're going to be on the back edge. And you likely won't be here in a few years if you're not continuously trying to figure out ways to innovate. And, this bank's been around for 140 years. And I like to say we've been what's called a slow follower, in which we are letting other companies kind of lead the way, and then we follow behind. But we realized at some juncture that if we're not figuring out ways to innovate, then we will fall farther and farther behind. And so we really needed to pick an area in which we thought we could be a first mover. And as we were moving into Baltimore, we realized that this was our opportunity. So that was one. And then we were almost like a startup within an existing organization. And I think what our senior leadership here at Fulton would like to see is us to kind of prototype. In fact, our senior vice president, Paul, and a lot of you on the phone or call today will recognize this. He said, listen, I can't wait for you all to fail so that we can learn from it and build from it. And I think what the bank's hope is that we'll prototype some of these efforts, and then eventually what works can be expanded into the rest of the commercial market. The second reason why we did this is that as we were looking at areas in Baltimore, we mentioned that we're making Baltimore part of our urban market initiative. We realized that we have a role to play to help the city and other urban areas succeed. And if we can help the economic growth and vitality of those regions by supporting the companies that are predominant in that area, then we will be doing something that's pretty significant. And there's a lot of life science companies in this area, a lot of technology companies in this area. And so we needed to do something different to figure out how to support the economic growth and vitality in the urban market initiatives. And then finally, these sectors, I mean, what the companies on this call are doing, they're really building out the next generation of healthcare, supporting solve and cure some major diseases. You saw what happened with COVID. I mean, the ability of these companies to respond in the way they did to develop a vaccine for COVID was astronomical. And so for us to figure out ways to help these companies get these life-saving cures to patients is really, it's worth a lot of the risk that we're taking on the bank side. And I think those were some of the major efforts. And then even on the technology front, there's a lot of companies within the Maryland Technology Council. And that's a wonderful thing about this job. I get to see them every day. They're building the better mousetrap. I mean, they're really building the bridge to the future. And for us to have just a small role in that is pretty significant. And again, was probably worth the risk. And our hope over time is that we know the statistics prove it out that some companies just simply won't make it. But when you looked at a couple slides back on some of the major investments in some of these other companies, we got unicorns in this market that from a financial perspective will make up for the companies that don't. So we really are kind of betting on the long-term picture here, not things in the short term, and we're willing to take a lot of short-term risk for long-term gain.
So Bret, when you were talking about this and the reasoning behind what Fulton Bank has done, you very briefly glossed over how successful you've been, and I'm not sure everybody caught it. How big is the portfolio today?
We've got over 120 companies in the portfolio now, and the interesting thing about it is 98% are pre-revenue. So we are really finding a pathway to support some of these companies. And the thing that's been really wonderful for me to see is that when I first started the bank, there was a default mindset at the bank that helping early stage innovators, entrepreneurs, and life science companies was a very risky thing to do. Like, support this company, automatically these companies would get our worst risk rating. And what's proved very fascinating to me is over the course of 2 years, we've had, of the companies that we supported, no defaults, and only of the 120 banking relationships, of that maybe 70 or some sort of debt facility, only 4 companies have missed payments, and that's only been for a course of 30 minutes before they could say, oh, I'm sorry, I forgot to move money into it. Long story short, these companies are performing well, they're growing, and they're performing better than the rest of the portfolio at Fulton Bank, some of the more not traditional companies that you think were less risky. So they're really starting to prove out that they aren't the risk that a lot of folks think that they are. And if we do our due diligence and really focus on the positives that they're doing, it can be a really fantastic thing for the bank. And so we're kind of demystifying the risk-averse nature of what most people feel about this business.
So it sounds to me like maybe you're also pretty good at picking winners. Maybe I need you to look at my stock portfolio.
I think the big thing is that we have a lot of winners in this area. I think that's what's proving to be the best thing about this. There's just, every day I'm fortunate enough to talk to 3 or 4 or 5, sometimes 8 companies a day that are just blowing my mind away in terms of unique, innovative things that they have. So I think it's more a testament to the ecosystem that entities like the Maryland Tech Council are helping to build, our major colleges and universities. And, I think this area is going to be right too, because when I was with the state, one of the partnerships that we have is with the federal labs and the return on investment initiative that the National Institutes of Standards and Technology was doing, which is to really get some of these innovative ideas out of the federal labs into the marketplace. I think when I left Commerce, the National Cancer Institute had 180 patents that were just sitting on the shelf because they didn't think it was their job to create companies. It was their job to cure cancer. But I think the federal government realized that to cure cancer, we need to create companies to get these life-saving technologies. So I think you're seeing the genesis of entities like the Tech Council, our great university, college university system, and the federal labs are really getting some great ideas in the marketplace. And then we have a fantastic portfolio of innovators and entrepreneurs that are really putting these to use and creating some good companies. So it's really making our job easy in terms of so-called picking the winners.
Yeah. Yeah, no, I couldn't agree with you more. You mentioned that you've developed new and different criteria for determining someone's creditworthiness.
Right.
What was that process? What process did you go through to determine what those criteria should be? So
back earlier in my slide deck, there was a really rough-looking chart, and it was really through that discussion with the 250 plus companies that we had in the first 4 months. It was one simple question, and it was just listening to the companies talk about what they thought they brought to the table. Like I can't qualify for credit, but I've got 3 patents, or I can't qualify for credit, but I might not be revenue positive yet, but look at my progress over the past 5 years when I started out at like negative $1 million net income. Or I can't qualify for credit, but I've gotten an SBIR, I've gotten something from TEDCO. And so when you start to really take good notes and look at all the different value propositions that these companies are bringing to the table, and then you look at those 250 meetings and then those key metrics that keep popping up, it was pretty simple. It's like, well, listen, if you just make this part of our credit policy criteria, odds are we're going to start picking the winners if we start trying to support the companies that have some sort of positive impact in one of these various metrics. So it was really just listening to the companies and learning from them what they thought their value was, and then trying to apply that to our credit policy. And so far, it's been proving itself pretty positive in that area.
No, I think that's an area, and obviously Fulton is ahead of the game in many areas, but I think that's an area in particular where you're out in front and in determining and developing new criteria for identifying creditworthiness. That's just phenomenal. I want to remind everybody that we will be taking questions in just a couple of minutes. So please use the Q&A function or the chat function if you have questions that you would like to pose to Bret. Bret, I want to come back to, again, something that I think you just spent a second on, which was you're collaborating with the Able Foundation with a fund. So you're going to be investing in companies. Will these be equity investments?
These will be equity investments. Yeah, we're starting with Able and Propel Baltimore for a couple of reasons. One, that I'm still building out this division. So when we start to look at equity, that takes a different level of validation and criteria. And certainly I don't have the bandwidth to do that. And Able has a superb, reputable background in terms of doing this for many, many years. They've been doing some great things in Baltimore. And so for us, and they were willing to help do the validation on our behalf. We would put the money in, they would do the validation. And so for us, it solved 2 problems. One, bandwidth to really validate these companies from an equity standpoint. And 2, it allowed us to start, like I mentioned, we have what's called the Urban Market Initiative for Baltimore. And so we picked a geographic area of the state that we thought could really benefit right away from our support, which was Baltimore. Able's a gold standard partner, and so that was a good place for us to start. So this would be direct equity investments in early stage companies, which is what we also wanted as well. We know a lot of equity investments comes a little bit later stage. You got to have a certain amount of revenue, got to have a certain amount of metrics or performance under your belt. But what was really missing was that early stage investing. So for us, this solved a lot of problems. But it is our full intention that if this is successful like we think it will be, we will expand this effort to the rest of the state shortly, hopefully Q4 of this year or early 2023.
So does Fulton have an investment bank division today?
We don't. We have we've got partners. We've got contractual relationships with Evergreen Advisors and Capital, SC&H, and we have a couple other investment bank partners outside of the state as well. So the thought process is that, we're not an investment bank, we're a retail bank, but if our portfolio companies need support through investment banks for IPAs, mergers, acquisitions, we have a clean handoff to one of our investment bank partners.
So
we have an office. We do have an office of capital markets that then, even though we have relationships beyond our contractual relationships as well. So if a bank doesn't, or a company doesn't want to use our contractual relationships, our office of capital market strategies can help connect them to other investment banks or mezz debt or other non-bank lenders or other partners in the equity markets as well.
So, so first of all, I'm going to have you come back for a Capital M podcast so we can talk about the capital markets and access to capital, because this conversation could go on for a long time. Before we get to the Q&A, Bret, I just want to ask you, this conversation has been amazing, and I've got so many questions floating around in my head, but I want to give time for others to ask questions. But before we do that, is there anything in this conversation that we have not covered that you were hoping we would cover this morning?
I can't think of it right now. Not this juncture. I think you've hit on a lot of the big topics. I think the biggest thing, the other thing which I touched on lightly, but what I've been really pleased with is that we've been able to become an economic development solution for the state. As well. When I was with the Maryland Department of Commerce, I mentioned we had a very large tax credit grant program, but as a lot of the companies that might have been recipients on this call today know, the state support can only go so far. And then usually typically you bring in a local county or economic development agency to help, which gets you a little bit further to that pie, but there's still a big slice that's missing. And so we've had, Montgomery County Economic Development, Baltimore Development Corporation, Baltimore County, Howard County, and then the state of Maryland have been calling us to bring us to the table as we're trying to bring companies into the state and region to help them help these companies stay and grow in this area. And it's really reinforced that, in this area, a lot of these companies want to rely on the public sector, but one of the things that the state's been missing is a strong private sector partner to inject capital to help support and grow the economic development of the state. And it's really those private sector partners that are going to drive this. And so I think we've been able to demonstrate that we can be that private sector partner, almost the tip of the spear, to help drive economic development and growth in this area. And it's something that is critically important because administrations come and go, and their economic development philosophy change with changes in administration. And so I've been there, I've seen it. It is, the state and local governments are really an incredible source of support. But depending upon who's in office, and I'm not talking Republicans or Democrats and political party agnostic here, they're just different. You all know that. And so it's not a complete reliance, because the next governor, whoever she or he might be, might have a completely different set of priorities, and it might not be supporting life science or innovation, and that's their prerogative. So you need a strong private sector partner to be able to continue to support and grow the economy through these ups and downs of these changes in political administrations. And that's something that we're starting to become, and something that I've been also surprised with in terms of how we can kind of fill that gap that's needed.
Great. So first of all, I want to thank you for not making this a political discussion, because that can be dangerous these days. So I appreciate that. So our first question has to do with managing your investor relations pipeline, but I want to expand on the question a little bit, because I'm curious, not only how do you manage your investor relations, and what does that look like for you in Fulton Bank, but how are you managing the company pipeline and looking at the collaboration with the ABLE Group and the Propel Baltimore Fund? How are you planning to manage the deal flow or the company pipeline?
Well, the investor part of what we're doing is relatively, as I said, that got approval in December of 2021. So we're part of that to be determined mode on that one. We got our first couple investments that we're looking at right now. So that's just starting. And so we really haven't been too deeply involved to really see how that's going to play out. So we just got the tools in the toolbox. Like I mentioned earlier, when we started in 2019, there were some things that we're going to do right out of the box. Some things we're going to have to wait a couple of years until we figure it out. And the investor part of it was the thing that took about 2 years to get going. So we're in the very infant stages. So that's yet to be played out, how we're going to continue to manage that. So we're kind of waiting and seeing. We're just starting to deploy our capital now.
Great, thank you. So the next question requires you to get your crystal ball out a little bit. So we're coming out of the pandemic recession. A lot of companies struggled, a lot of companies failed, many companies are coming through it pretty strong. But now we're dealing with supply chain issues, we're dealing with the war in the Ukraine and the effect that sanctions on Russia are having on the economy. What is Fulton Bank seeing? What if you had to predict some of the challenges that companies are likely to see over the next 6 to 12 months? What do you think they're likely to be?
Well, surprisingly, I was looking over some of the data from year-end 2021, and despite the pandemic challenges, it was a pretty remarkable time for companies in this space. I think investment was at an all-time high. Deals by industry were incredibly high in this area. The healthcare, life sciences deal there was a lot of successful deals, more so than the IT and cyber. A lot of tremendous successful exits. And so I think that speaks to a couple issues. One, technology is still rapidly increasing. This is kind of what we're seeing here at Fulton Bank. Two, chronic diseases and issues are ever present. And as COVID kind of played out, the role in life science and bio companies to solve some of those healthcare solutions are, again, going to continuously to be needed. Again, you got entities like the federal agencies, DOD and FDA and NIST and NIH that are spinning out technologies in this area, more so that are going to continue to create some positive efforts. And then, I mentioned I was at Hopkins for 10 years, way back then, back in 1996 to 2006. And at that time, it was a dirty word for a professor to say, I'm going to commercialize my technology. I'm in this for the pure sake of research and to get published in an academic journal. I had one professor that came to me and at this time said, for me to be successful, I need all of my faculty to retire and I need my students to become the new faculty. And that's what you're seeing. That was back in 1996. So now we're 2022. And that's what you're seeing, is that you're seeing a new generation of faculty come in that have a different mindset towards tech transfer and commercialization. You've got, these colleges and universities that, for example, one of the companies in our portfolio is a researcher out of the Applied Physics Lab, and he just won an award that really gives him a 2-year sabbatical to take his idea and try to commercialize it. He continues to get paid through the Applied Physics Lab, and if he fails, he can come back to his position within the Applied Physics Lab. We have entities like Fort Detrick that did that, and so you're seeing these innovative efforts towards commercialization and really and innovation that I think are kind of cutting through the negative aspects of what's happening out there in the world. Now, on the world here, I just got some information from Fulton Bank the other day in terms of what's going on with Russia and Ukraine. Our folks are thinking, again, we could be proven wrong. This could escalate in ways that we just can't imagine. But we do not think that this is going to be sparking a recession, maybe stagflation, where we're going to have higher inflation and tempered growth, but that we think that a lot of the downside has already been priced into the market. And that at some juncture, I think we're going to continue to see some short-term growth. So we're looking at long-term, and we think if you continue to be focused on the long-term, some of the other things I mentioned are going to kind of cut through what's happening on the geopolitical scale to continue to help support the growth of the economy.
That's great and encouraging news. I appreciate it. So
I'm calling tomorrow, but that's hard to call today.
That's great. So Bret, I can imagine that there are a lot of people that have joined us this morning that are going to want to contact you after this. Just to kind of manage expectations a little bit, tell us what your day is like. How many companies do you talk to over a given day? How full is your day? What does your day look like?
It's my wife would attest. It is pretty hectic. I mean, again, the great thing is I get to talk to these companies. I'm averaging maybe on any given day, on average, about talking to different 5 companies. I mean, the one thing that COVID has done is it, like we're doing today, allowed us to communicate with a lot more entities. Kind of before COVID, I'd be, I live out in Harford County. I'd be driving down to Montgomery County to meet with one company. It's a 1 hour, 20-minute drive, 1 hour, 30 to 45 minutes, depending upon traffic. 1 hour meeting, coming back, and that's 4 hours later. Now a lot of these companies, we can talk to 5 or 6 different companies a day using the virtual option. Obviously, in person is, you still got to have that type of relationship, but the ability to communicate virtually has allowed us to reach a lot more folks. So basically our day is, it's talking to companies, and a large part of that is then once we talk to the companies and really try to get a sense of who they are, what they're about, what they're trying to solve, what their goals are. It's really trying to create that path to success within the bank. And then we spend a lot of our time, as I mentioned earlier on the phone, one of the things that we really put a lot of strength, a lot of emphasis in is that helping companies connect in the ecosystem. We had one yesterday talk to us, an early stage growth company, and they're really struggling with how to make that pitch to an investor. And so we connected them to your venture mentor program that you have at the Maryland Technology Council. So we had them fill out, because the best thing that we can do is to surround them with expertise, with folks that have been there and done that, to help them get to the next stage. Now that won't help me in terms of taking international wire, bank fees or whatever like that. But our hope is that it allows them to get to the next stage, and eventually we'll do okay. So we do spend a lot of time connecting to the ecosystem, because that's I think the unique thing that we bring to this table. I think most other companies, you might be using a bank that's up the street just because it's convenient. But you go in, you talk to that teller, and you ask them what an SBIR is, or you ask them what what TEDCO is, or what an angel investment is, or a Series A, and the bank's not going to know what it is that you're talking about. So I think the unique thing is that we may not understand your exact technology, but we can speak your language, and so we can help you, and we have a general sense of where you need to go. And so I do spend a lot of time connecting to the various points of the ecosystem. We have a large portfolio of funders that we've worked with, so it's making introductions to venture capital firms, and then connecting to the federal labs, connecting to colleges and universities, or some of the exciting things that I've also started is I'm chairing the chair of the strategic planning committee for the biomedical engineering department at College Park. So, and then we also have a pretty strong, growing strategic relationship with Johns Hopkins. So I'm getting to know a lot of the students that are coming out of these and have some great ideas. And one of the things I'd like to figure out in the future is a seed fund for student entrepreneurs to help, really get their ideas to the next stage. Because again, to go back to that statement from a professor many, many years ago, for me to succeed, I need my entire faculty to retire and be replaced with my students. I like to say that someone once told me graduation day at our colleges and universities is the greatest day of tech transfer in the state, because of all the incredible minds that are going into the commercial sector. And so, the ability to kind of work with these students is pretty exciting, because they are the future from where we're going to go and where we're going to continue to work. So that's kind of a day. And, the greatest thing about the day is just to be able to work with these companies and just to be amazed at what's coming next. A lot of you on the call know what's coming next because you're doing it. But a lot of you don't, and you'll be just shocked in some of the fantastic things that's happening in our ecosystem here in the state of Maryland.
Yeah, Bret, I love your perspective. So we're out of time, and I just want to say that a couple of things. First of all, I want to remind everybody that Bret's phone number is in the chat room, and he was gracious enough to give that to us. And remember, fultonbank.com, if you want to check out the bank and learn more. Contact Bret. He can squeeze you into his day, although it sounds like it's pretty full. And again, just remind everybody that this is the Executive Insight Series for the Business Continuity Task Force. So if you're facing challenges, if you would like to speak to one of our executive mentors, please reach out to the Maryland Tech Council at mdtechcouncil.com, and we'd be happy to connect you with one of our task force members or one of our mentors as well. Bret, I know that your connection to the community is amazing. You sit on our board, you support the Tech Council and all of our members. You're part of the steering committee forming the Baltimore Regional Tech Council. You're involved with the universities, as you pointed out. It's amazing your perspective, your support for the community, everything that you're doing. The success that you're having at Fulton Bank is phenomenal. It seems like you've made the transition from economic developer to banker in an amazing way. So really appreciate your time this morning. I'm looking forward to having you back on the Capital M podcast and have a deeper conversation around access to capital. Thank you so much.